According to the World Bank, 1.4 billion people lack access to a bank account. TransUnion states that 170 million Indians now have access to one loan. Despite large-scale financial inclusion programs, there are still 570 million individuals who are unserved in the country. These are people who have never taken a loan and hence don't have a credit score.
Now the challenge is, how do you get these people included into the formal credit system? Clearly, bank accounts by itself do not suffice, because a lot of people in India, because of Jan Dhan Yojana, have got access to bank accounts, but most of them are still not able to access credit. So that is what motivated us to pursue this study. Is there a way to capture creditworthiness of borrowers using some data that they are already creating? Now, why should we care? We care to the extent that many of these borrowers may have productive use of capital. So they are financially constrained, but they have a good business idea. They may open a nice shop that may generate them income, or they could invest this capital in their health or education. Because they are financially constrained and they cannot access credit, they are not able to make this productive investment. So government and policymakers also care about these issues.
This is also an opportunity for banks and financial institutions to broaden their market. They broadly serve two purposes. One is to provide an individual's loan history to the credit bureau. Second, they seek credit scores from the credit bureau when someone applies for a loan. This creates a barrier for new loan seekers. If they don't have a credit score, they can't get a loan, and because they can't get a loan, they cannot gain a credit score. Finding alternate measures to evaluate credit worthiness or default risk would help these borrowers.
Again, the idea is that many of these people, although they are financially excluded, many of them are digitally included. There is 98.7% mobile phone penetration in developing countries. Many of these people have access to internet via their mobile phones as well, which is why we are focusing on digital data captured from mobile phones.
This alternate data model includes the deep social footprint and the mobile footprint of an individual. It can help in two ways. The first is to use captured consumer behavior to screen borrowers and to better predict default probability. Second, real-time tracking of consumer data can be used to create early warning signs of potential financial distress. It also enables banks to make necessary interventions to boost loan recovery.
So people who did not have credit history earlier can now be screened using this alternate data models, and so banks can lend to them. And so consequently, even the banks will have better recovery.
The study used anonymized loan application data from one of the large Fintech players in India between 2016 and 2018. The digital data included the number and kind of apps installed on the applicant's phone, their call and SMS data, and the duration of phone usage. The average borrowers from that platform were 30 to 40 years high-risk individuals borrowing for medical, travel, consumption, and educational purposes. And 40% of them did not have a credit bureau score.
Why is this, the universe of loan applications, important? Because we know who is rejected and who is accepted. So if we are coming up with an alternate data models, we can do this counterfactual analysis, that if we were to use our alternate data model for loan approval decisions, what fraction of the denied customers would get approved?
The study divides the data into training and testing samples. The data models are first trained on the training sample. The standard information that banks use for evaluation, including credit bureau scores and basic computer details, is used for benchmarking. The alternate data model is then tested using out-of-sample test data to evaluate borrowers.
Now, ex ante, all we wanted to see is, can alternate data models do as well as the credit bureau score? Surprisingly, it turns out that the alternate credit scoring model has better predictability as compared to even the credit bureau scores. And it's not better by a small margin, it is better by a huge margin. So the headline result is that the alternate data model has significantly better ability to predict defaults as compared to the credit bureau score, even for those who are included.
One of the reasons for this outcome would be that the current credit bureau scores rely on a thin history and a limited trail of data. Because the credit score is based on scarce information, it falls behind the alternate data model that considers deeper measures of social capital.
Then we use the same model to test whether this model works with borrowers who did not have a credit bureau score. And remember that we did not even train the model for this set of borrowers. The model was trained on the set of borrowers who already have a credit bureau score. Despite that, it turns out the model does a great job of predicting default for borrowers who did not have a credit bureau score.
It was also observed that among the digital data that was used, some features mattered more for default prediction. Simple measures like the number of phone calls, the number of contacts on the phone, apps installed on the user's phone, etc. mattered more than the credit bureau score itself.
So first, we find that as compared to the traditional bank model, the credit bureau plus customer characteristics model, under our alternate data model, the approval rate would go up by 9%. So 9% more borrowers or more applicants would get approved for credit. Now most of these gains is occurring for people who were denied a loan simply because they lacked a credit history. So when we focus on the sample of borrowers without a credit history, about 17% of those who were denied loans would get access to credit now.
The borrowers who would benefit from the digital data model were observed to be people from regions where there are fewer bank accounts and fewer credit access per capita. Most of these borrowers were also found to have low incomes.
Our study has broader policy implications as countries around the world are developing new modes of financial intermediation and seeking to expand access to credit for the traditionally underserved, such as open banking framework. Our study adds to the open banking policy debate by suggesting that alternate data coming from e-commerce or big tech websites also should be within the ambit of open data sharing framework.
As the country grows digitally and with the onset of Aadhaar and UPI, there are more avenues to measure the digital trail of borrowers. With more verifiable data, alternate credit scoring can be used to expand credit access to those who are financially excluded.
We examine the discriminatory ability of mobile and social footprint captured from an individual's mobile phone in predicting their default risk. We conclude that this alternate data captured from an individual's mobile phone has significant ability to predict default risk. Importantly, these alternate data have incremental predictive power over and above the credit bureau score.
There are existing fintech lenders who rely on similar alternate data and machine learning algorithms for credit underwriting decisions and provide first-time loans. This goes to show that the alternate data model complements rather than substitutes the existing credit bureau score.